other day. Okay, and let's get this on pen. Okay, there's a couple questions in there. I noticed I didn't have any numbers. One where I didn't have any numbers, so for some of those we may have to skip those. But for other ones, for the most part, we should be able to work these. Okay, so what's going on in this one? Agram Corp had 1,000 defective units of a product that cost $3 per unit in direct costs and $6.50 per unit in indirect costs when produced last year. The units can be sold as scrap for $4 per unit or reworked at an additional cost of $2.50 and sold at $12. The incremental income from the choice of reworking the units. And when you look at this, they're just asking at the choice of reworking. They're not asking you to decide whether you should rework or not. They're just saying what happens if you have to rework these. And so if that's the case, you would go ahead and do what? Take the $12 per unit that you're going to be able to sell those for, minus what? Minus and it's the cost for the rework, right? I mean, not for the rework, but for the what? Yeah, for the rework at $2.50 per unit. Okay, so if I can sell them for 12, and I'm going to have to pay $2.50 per unit to rework, those are the only relevant costs, right? It's Oh, is it? Oh, okay. So it's supposed to be 950. Okay. So 950 per unit, thank you, times what? Times 1,000 units. So that should be 9,500. Okay. So I guess if D had 9,500, then D would be the right answer. Okay. Again, the takeaway here is what? It is simply the cost of the rework that they asked us for, right? Okay. Okay, good. Let's go ahead then and let's take a look at this next one. SOAR Incorporated is considering eliminating the mountain bike division, and they want to know what is the impact on the operating company from eliminating this business segment. And remember that we're only going to pick up what? The avoidable costs, right? Any unavoidable costs we would ignore it here. And so they tell us that sales were 1,050 and variable costs are what? 860. Okay, now this question didn't really ask this, but we have a contribution margin then here of what? 190,000. Okay, but we still need to consider any avoidable cost. And so we say that the fixed cost of the division were 193,000, and if the mountain bike division is dropped, 30% of the fixed cost would be eliminated. So we only consider what? Those avoidable costs if we get rid of the segment. So it's not the whole 193,000 that were allocated to the division. It's what? The 30% that could be avoided if we got rid of that segment. So what's that? 57,900. Okay. So 190,000 minus the 57,900 is what? 132,100. Okay. Okay, good. Stop me if you have a question because I'm going to roll. Number 3, a company has already incurred 55,000 cost in partially producing its 3 products. Their selling prices when partially and fully processed are shown in the following table with the additional cost necessary to finish their product. Based on this information, should any products be processed further? And so what are we going to do? We're going to look at the selling price minus the cost to further process. So for our product A, it's this 108 minus what? Minus the further processing cost that has a cost of then should say contribution of 73. Then we look at B, and B is what? 124 versus the additional processing cost of 42. That gives us 82 as an additional contribution. And then we have what? We have this 141 for product C now. I'll just write it here. 141 minus what? The 45? And that gives us a contribution of 96. Now, they tell us that the unfinished selling price for product A is 72. So should we go ahead and continue to process product A? Should we continue to process product A? If there's going to be additional contribution of 73 and the unfinished selling price is 72, we should go forward, shouldn't we? Okay. How about product B? Product B is going to be a no because what? Unfinished selling price is 83 versus the additional money we'll get in if we further process of 82. So that one's not worth it, right? So no B. No to B. How about A? We could sell it for 94 if we don't go any further, but if we sell it for 96, we can keep going, right? So we can make more money, I should say. So products A and C are the ones that we should continue to process, right? Okay. Okay, good. Let's take a look at this Wade Company and what's going on here. Wade Company is operating at 75% of its manufacturing capacity of 140,000 products per year. A customer is ordered to buy an additional 20,000 units at $32 each and sell them outside the country so as not to compete with Wade. The following data are available, and they tell us in producing 20,000 additional units, overhead costs will remain at the current level, but incremental variable costs of $6 per unit would be incurred. What is the effect if Wade accepts the offer on this order? And the trick here again is what? To pick up avoidable costs in the consideration, but we would ignore unavoidable costs. So what happens? We sit here and we could sell these for how much? $32 each. And we're going to pick up what? Should we pick up the direct materials? Pick up the direct materials. Pick up what? Direct labor. Should I pick up this fixed overhead? Don't pick that up because they tell me down here that what? The variable overhead is $6. So variable overhead would be avoidable. The fixed would not. So if you go ahead and you subtract all of these off, that means that we're going to have a contribution of $5 per unit. And these people want to buy how many units? Oh, they just asked me per unit. So I'm good to go right there. They don't have to extend it out. Did they tell me the number of units? 20,000. So I guess if they had asked me the number of units, I would have multiplied that times 20,000. But they didn't ask me the total. So they just wanted this. Question? Okay, good. Let's go ahead then and let's look at number 5. And I don't know why it had to go all the way to a next page, but I fight with those things constantly with these test banks. But let's take a look at number 5. Which of the following statement is true regarding absorption costing? And guys, again, I would pay close attention to all these questions, to be honest with you. You should be really working through every single one of the practice in prep for your exam. You should be looking at every one of the practice finals per chapter. The practice finals that we did are comprehensive. This one, right? And in doing that, the chances that you're going to see some very familiar questions on your final are very high. Okay. Particularly some of these word questions, you may actually see exact questions in some cases, because it's supposed to happen randomly, that a certain amount of questions end up being in the practice quizzes and stuff, but I don't use the random access to the questions. I go in and I pick out questions specifically, and sometimes I may pick out the exact question if it's a wording question. Okay, so you want to make sure and take a good look at those, because those can be a little tougher sometimes when you see them on the exam. So anyway, which of the following statements is true regarding absorption costing? It assigns what? All manufacturing cost. If we were dealing with our variables, which one are we going to leave out? Good. Fixed manufacturing overhead would be left out, right? Okay, whereas absorption picks up everything. Good. Okay. Regardless of the system used in departmental cost analysis, indirect costs are allocated, direct costs are not. Now, be careful, because this gets a little confusing, because later on we're going to be working some questions where we're going to be taking the rent expense, which is an indirect cost, and seeing how it gets allocated to the different divisions and stuff, and it could lead you to confusion. I'm like, well, we're supposed to allocate them or not? For analysis, you don't allocate them, but for financial reporting purposes, because remember we said that the SEC and the FASB requires that public companies report segment information. Part of that process would involve allocating the indirect costs. So in some cases, we're allocating for financial reporting purposes, but for our internal decisions about, should we keep the division or eliminate the division, etc., we do not consider the indirect cost. Okay? Okay, good. Coming over, number 7, a cost center is used in a business that incurs cost without generating revenue. All of the following would be considered cost centers except, and I think you might see a question a lot like this, but if it's producing a product, okay, then it's going to be considered a profit center, not a cost center. Whereas you look at these others, they're not really producing anything. They're trying to help us sell or account for or administer or whatever, right? Okay. Okay. The most useful data for evaluation of a manager's cost performance is based on controllable costs. That's why the avoidable costs we would consider relevant. The unavoidable costs we would not, because they cannot control those. So it's controllable cost. I don't know. I looked at number 9 and I forgot to indicate the answer, and even I'm having trouble with this one. Overhead cost variance is, and I think the answer is the difference between the actual and the budgeted costs caused by differences between the actual price per unit and the budgeted price per unit. Let me look at that one, or either that or maybe E. I don't know. I don't like questions like this. And I couldn't remember the answer, and I'm looking at that. I guess it's E. I don't know. But this is the overall overhead cost variance. If you have this on your test, I'll tell you the answer during the test. I don't even know the answer to this question, to be honest with you. I look at stuff like this, I'm like, I don't know what they're talking about. Okay. All right. Let's take a look at number 10. Okay. And when we look at number 10 now, they are asking us which department has the greatest contribution to overhead. Okay. And our trick is going to be to pick up the the unavoidable cost for each one of these. Okay, the direct cost only. So we'll have sales. How about cost of goods sold? Cost of goods sold. How about direct expenses? Yes, we'll pick up direct expenses, but we will not pick up what? These indirect, right? So once you realize that, that's pretty easy, right? And you just sit there and you pick those up from up there. Department 1, sales versus the what? Versus the cost of goods sold. versus what? Just the direct cost. Okay. Oops. What did I do? Pick up Department 3's cost of goods sold there. I don't want that. I want what? The direct. Okay, and I do that for all three departments, and when I do, it looks like what? Department 3 is the winner? Okay. Okay, good. Let's take a look at number 11, and we have the black division and the navy division, and oh, that was the one that didn't have any information? Yeah, okay. So I guess the answer was what what did they want? Which one has the largest? Or we needed each of them, departmental income, okay, for each one of them. And the real takeaway from this question, guys, is if they gave us stuff, I'm assuming that, what? Is it? Is it in one of the quizzes with all the information? Okay. The key thing to take away from this, because I don't have the information, I didn't look it up, but one of the key things to take away is notice they do allocate the rent when they're asking us what? See, there was rent expense and they allocate it. And you're saying, well, wouldn't rent be indirect and would we consider it for operating income? If they're asking me the operating income for the division, that means they're asking for what? They didn't ask me, should we keep the division or what would happen to the profit of the overall company if we got rid of one of them. When they're simply asking for a financial reporting number, we do allocate the indirect expenses, don't we? Okay. On your test, they may ask you any one of the line items here. When I say any one of the line items, it's perfectly legal on the, I don't know if it's legal, I think it's stupid actually because we already studied this, and this is actually financial accounting class. This is 101A, but they may very well ask you what? Operating income on this? You know, some of you got a real bad habit of checking your phone right while I'm telling you something that's going to be on the frickin' test. Look, I don't care. You know, if you get it, if you miss that question on the test, then you miss it. I mean, it doesn't affect my life at all if you miss the question. So I'm telling you about looking at your phone while I'm telling you about this stuff because there's a chance that you're going to see a question on this test that asks you the gross profit on this. And this is the kind of question that you come up to me later and say, I wasn't ready for gross profit. Well, that's because you were doing something with your phone while I was telling you about this. Okay? So be ready to answer a question that may what? That may very well ask you something about what? Gross profit? On a question like this. This one asked operating income, and even though we can't see all the numbers here, the important takeaway is what? That they picked up this rent expense and they did allocate it. When they start asking for numbers like operating income, etc., if they're sitting there and they're simply asking you, you know, should we keep this division? Not simply, a different question. Should we keep this division or what? You would not allocate those indirect costs. Okay? Okay, good. Come over. And let's take a look at number 12 here. And we want the amount of maintenance cost that will be allocated to what? To the baking department. And when I do a question like this, I just say to myself, okay, I'm dealing with the baking department, and they're asking me about whose cost here? The maintenance cost of what? 12,000, and it's based on floor space, right? So I try to kind of isolate because when I look at these questions, it's easy to get confused about what you're supposed to be looking at here. So I try to allocate the most isolate the most relevant ones here. And so we need to know the floor space, right? So if you look down here, they go ahead and they add up the floor space for all three of these to give me the total floor space. they pick up what? They pick up that maintenance cost of 12,000, and then they figure out how much of that is, who are we looking at? Baking here? Okay, so 1,500 divided by the total times 12,000 is $6,000. Okay, so the answer here is E. Okay, good. This one, department's contribution to overhead as a percent of sales. Okay, so now we're going to do what? Just pick up the direct costs, right? So we have our sales, we have our cost of goods sold, we have our what? Direct cost only, because we're trying to get to the contribution. Remember, contribution contributes to first fixed cost and then what? And then profit, right? And so if we go ahead and we have the direct costs that come in, then we have a contribution of 28,000, and then they ask me as a percentage of sales, so I'm going to do what? I'm going to pick up the sales number as the denominator, the amount of contribution is the numerator, and I get this 14.9%. Okay. Number 14, and they give me this information here, and they want to know if I can compute the amount of purchasing department expense that should be allocated to fabrication. Okay, so again, when I look at these, I try to say, okay, I know I've got to take that purchasing department, and I know I have to allocate that, right? 32,000, and I'm doing it for who? For the fabrication department, and they tell me that for purchasing, it is based on number of purchase orders. I don't know where they said that. Here it is. It's got to be purchase orders for purchasing, right? And so I add these two together. What do I get here? 6,000? What is this? Oh, number of orders. Sorry, not floor space. Thank you. So it's 20 orders. Okay. As the total, and fabrication had how many? 16 out of the 20. So 16 divided by 20. 16 divided by 20 times the 3,200 is going to give me what? 25,600. 25,600. Okay. Is 25,600? Okay, good. So what's that? E? Okay. Okay, good. Same question, but now they're asking for what? Assembly? Different department? And obviously that's going to be what? That's going to be the 32,000 times now what? 4 divided by 20? Okay. I'm not sure what you're saying here. Okay. Okay, so it's what? Purchasing department expense to who? Assembly, right? And so assembly's got 4 versus the 16 versus the 20 total, right? Okay. And so when we allocate that, what do we get? This 6,400? Okay. Okay, good. Standard costs are preset costs for delivering a product or service under normal conditions, right? I guess. I don't know. If they say so, okay. This is, again, another one of those things. If you want to say it's a preset cost, I mean, you could probably talk to a managerial accountant for you could probably lock them in a dungeon and tell them you won't let them out until they get this answer, and they'll just die in there because they're not going to sit there and say, "Oh yes, preset cost, that's what it is." Okay, but if they want to insist, then that's the answer to that question if they say so. Okay, a budget based on several different levels of activity, often including both a best case and worst case scenario, is a flexible budget. I don't know that it's best case and worst case scenario. I don't know where that comes from. Maybe, maybe not. I mean, you could do that if you're trying to get the outside ranges of what could possibly happen, and then you're going to compare the actual to that. I mean, I guess that's a way of analyzing things, but it's not like, people in managerial accounting walk around in their heads with, yes, flexible budget, worst case and best case scenario. Okay, but there it is. Okay. Okay, good. Number 18. We look at this one, and company's flexible budget for 12,000 units is given, and they want to know what would the operating income be if we produce what? 15,000 units. Now, the problem I have with this question, I guess this is I guess kind of a flexible budget. Relevant, but it kind of is like chapter 5 too in a way to me. And that what we have these contribution margin of what, 24,000 units. So if I take the 24,000, I'll just write it up here. And I divide that by what, 12,000 units? Then I'm going to get a contribution margin per unit of what, $2? Okay. Now they're telling me that I'm producing what, 15,000 units? Is what they want the answer for. So if I took what, 15,000 units and multiplied it by the $2 per unit, I'm going to get a contribution margin of how much? 30,000, right? And if I then take off my fixed cost of 16,000, now I'm going to get a operating income on this thing of 14,000. So the choice here is what, E? Okay. Okay, good. Now this one is good practice for you. Okay, we hadn't seen a problem quite like this before, but I think that it's fair game for us to ask you this on the test, and you should be able to take what we've learned and what we've practiced with to kind of fight your way through a question that doesn't look exactly like some of the ones we've seen. Okay, and the way you do that is you always look when you see these variance questions, what variance do they want? And they want direct materials quantity variance for the month. Now I'm going to put them on the test itself, okay, so you'll be able to see the formula, okay? But what I recommend you do is rewrite the formula next to every question that you're going to work it, just so that you're not having to keep flipping back and what was it, and eventually you mess something up in the translation. Okay, so even though it'll be on the top of the page, write it down next to the question when you need it to be. Okay, so if they're asking me the quantity variance, I'm going to take what? Standard price. And it's going to be actual quantity minus what? Standard quantity, and it's going to be standard quantity. I messed up my own trick here. Ugh. It's going to be what? Standard quantity minus actual quantity purchased. Before they were playing stuff from the 40s. Now it's like, the modern stuff, I guess. So maybe they've worked themselves up to the 2000s finally. Okay, so what happens? We're sitting here, and we got to come up with a standard price. Do we have a standard price for materials? Huh? Standard price is what? 90 cents per pound? Okay, so I'm going to go ahead, I'm going to pick up that 0.90. Okay, standard quantity for the materials, it's usually something I have to calculate, isn't it? So I'm going to go ahead, I'm just going to go ahead and pick up the actual quantity, and they say actual quantity purchased and used is how many pounds? 58,000 pounds, so I can go ahead and pick that up. And why did I say purchased here? God, I'm losing my mind. That music's driving me nuts. This is what? Standard quantity what? Used if it's the what? If it's the quantity variance? Actual quantity used. It didn't hurt me in this problem because what? They said used and purchased. But I'd have to be careful like for some of those where they gave me different amounts. So if I'm doing the quantity, I'd have to get the used, right? Standard quantity used. So that's 58,000. And then I want to know what the standard quantity is supposed to be. Well, they tell me it's what? 6 pounds, not dollars. 6 pounds. Getting that from right here. And how many units did they actually produce? 10,000 units. So the 6 pounds times the 10,000 units gives me 60,000 pounds is what they were supposed to use. And they only use what? 58. So 0.9 times 2,000. And that's going to give me what? 1,800 favorable. Why is it favorable? It's positive as the sort of, mechanical answer, but also it's favorable because they were supposed to use 60,000 and they only use what? 58,000? Okay. Okay, good. Again, I think I'll put up the solution. They think this question's hard. I wanted to cut these things out, but I just want to notify you that here's a question that the textbook has identified as hard. And I'm sitting here, by the time we've worked, what, 52 of these? I mean, this is just like, really? This is hard? Okay, but that's something they think would be difficult for you to work. I don't think it should be. But I'll leave this in here. I'll put this solution file up. Okay, you'll see it when I put the video up and stuff. Be careful with that. Don't start looking to that as the way, the better way or something to answer it. I'm telling you, the way we're doing this is, I look at it, I'm like, yeah, it's hard if you try to do it like this. But if you do it the way we're talking about, it's not that bad. Okay? Okay, good. Come over. And let's take a look at this one. Same set of facts. What I like about this question is we cover all the different variances. These set of questions, we cover all the different variances with the same set of facts, right? Okay. So now we're looking for what? Direct labor rate variance. Direct labor rate variance is going to be actual hours times what? Standard rate minus the actual rate. Okay. And so my actual hours are what? 4,900? No? 4,900? So that's 4,900 actual hours. Standard rate is what? $12 per hour. The actual rate was what? And for this one, we need to do what? Pick up the 56,350, and we divide it by the actual number of hours they worked, right? And they worked what? 4,900 hours? Okay, so 56,350 divided by 4,900 is 1,150. So 4,900 times 50 cents is going to give us 2,450. And that's what, favorable? Okay. I don't think so. Okay. Let's take a look at this one. So now we've got the labor efficiency variance. Did we work this before? I don't know why this seems vaguely familiar to me some reason, but maybe I picked one or two of these instead of the whole set of them. Anyway, so now we've got the efficiency variance. Efficiency variance is going to be what? Standard rate times the standard hours minus the actual hours. So you guys don't really even need the formula, do you? Okay, so that's $12. Okay, and then we've got what? We know that the actual hours are 4,900, right? But what are the standard hours? Well, to get the standard hours, we have to pick up the number of units they produce, which was 10,000, and we got to find how much are they supposed to spend per hour? 0.5. I mean per unit, I should say. So 10,000 times 0.5 is what? 5,000? And so that's 12 times 100, which is going to, oops, forgot to write the 12. 12 times 100 is 1,200. Okay. I know. Geez, I thought I was, I feel so boring now. I'm not doing all those sound. I need to add sound effects to these. Okay. One thing I wanted to say, guys, about the way I do these, where I call it the ninja approach, kind of jokingly and stuff, and I saved that last one where you have to make a calculation for last. Part of the reason I do that, I think the reason I got in the habit of doing these questions this way, is that I like to have as that last one where I'm going to do the calculation, where I have to pull the numbers up, because you kind of get that sort of, like Florida says, got a good feeling about this one. When you sit there and you multiply that out and it does what? It's pretty close to the number. If you get something outrageous, you know you made a mistake, right? Almost immediately. And you don't have to go through the whole drama of sitting there and having to calculate, well, why is it wrong? If you wait until that's the last number, you kind of know going in, oh, okay, wait a minute, I pulled the wrong numbers out of that, right? And it kind of reduces the stress a little bit. Okay, come over and let's take a look at number 22 here. And yeah, this question is not anything like we've worked before, and you probably will have one like this on your test, okay, in which they ask me to do what? To come up with the actual direct labor cost for the period, okay? And in here, they tell me that they had a standard direct labor cost of 400. Okay. And then they give me what? They give me the unfavorable rate variance for labor and the favorable what? Efficiency variance for labor. And what this question was expecting you to understand is that what? The standard and then plus or minus the variances should give me what? The actual, and that our variances are made up of the efficiency and the rate, aren't they? Remember, that was where we started this whole thing is, hey, we've got this spending variance. We want to know how much of it is price. We want to know how much of it is quantity, right? Or how much of it is rate, how much of it is efficiency, the number of hours. So if you sit there and you start with the standard and you add any favorable variances, which we had this favorable rate variance, and then you subtract any unfavorable, and it doesn't have to be that the rate is the favorable one. What is it? That the rate is the favorable one. I mean that the rate is the what? unfavorable one and the efficiency is favorable. Could it go either way? Okay, in this question, the rate variance is going to be, now I've got these backwards. 10,000 unfavorable direct rate variance. This one, the direct rate variance is the rate variance is unfavorable and the efficiency is favorable. Okay, but it could go either way. Okay, so to get to the actual, you would do what? You would add the unfavorable because what's happening? The actual is more than the standard, right? And you would subtract the favorable because in that case the actual was what? Less than the standard, and that's how you get what the actual was. Okay, I don't like questions where they make us work backwards. This is sort of testing your understanding, though, of what we're doing here. Why are we doing this? Okay, so if you have a standard, they give it to you like that, right? You have to do what? If it's favorable, you're going to do what? You're going to subtract it to get the actual. If it's unfavorable, you're going to do what? Add it to get to the actual, right? Question on that one? Because we hadn't really talked about this before. There's not really an equation that I mean, well, I guess I can give you an equation. It's going to be the standard and I'm not going to put it on the test for a question like this because I'm not going to give you how to answer any one question, okay, which is I think just that one question. But it's the standard and it's going to be what? Plus an unfavorable and minus what? Minus a favorable is going to equal what? Assuming I can spell, which I cannot, is going to equal the actual. Right? Okay, because what? If I'm less than standard, then it's favorable, right? So if you want to get to the actual, subtract that from the standard. If I'm more than standard, it's unfavorable. So if you want to get to the actual, add it, right? Okay. 23? Capital budgeting decisions usually involve an analysis of, when we get into capital budgeting, that's long term, right? Operating budget's going to be a single year. Okay. 24, the net cash flow of a particular investment project does not include depreciation. Depreciation does not affect cash flow. Which of the following is an object of capital budgeting? Return on investment? An objective of capital budgeting? I don't know. And this one was so stupid, I just put a bunch of dumb letters next to it. I'm not sure why the letters came out the way they did either. But, okay, I don't know. I guess if they want to say that which of the following is objective of capital budgeting, which is to earn a satisfactory return on investment, okay. I guess we're screening investments, and that's an objective of it. Okay. Okay. I want to take a break right now before we get into some of these computational ones because we're about halfway there anyway, and I want to go get the evaluations. So let's take a 10-minute. Let's make it 11:30. We'll come back at 11:30 and we'll wrap this thing up. So I got time to go find those evaluations. Okay. So about 15 minutes, 13 minutes, whatever. Let's resume our discussion here and just to make sure I still got audio there. Yes, I do. Okay. So let's go ahead and we're going to start to take a look at some of these capital budgeting questions. Now, something that I discovered as I put this exam together, this practice final together, is there are some questions where we have uneven cash flows that occur over multiple years. And if the cash flows are uneven, then you're going to have to use each one's present value of a dollar factor to be able to come up with the present value over multiple years, as opposed to the way we've used the present value of the annuity factor for the annuity ones. Okay, and so that was the only trick that was sort of different for some of these than some of the ones that we saw in some of the earlier practice midterms. So they give us these cash flows per year, and then they give us the present value for 1 year for $1, for 2 years for $1, for 3 years for $1, right? And they tell us that the project requires $30,000 investment. And they want to see, let's see what the question is, what is the net present value of this project? So if this is now, and these cash flows are in the future, we're going to have to use present value factors on this, right? Okay, so we've got the 12,000, that cash flow for the first year, and that's going to have to be discounted what? For one period to be given to us in the numbers for now, 9091, and that's going to give me what? 10,000. 90920. Okay, good. Okay, and then I've got what? I've got this $8,000 for year 2. And I've got to pick up the present value factor for 2 periods for $1, 0.8264. And that gives me what? 661120. And then I do the same thing for the 10,000 here for year 3. And that's going to be times 0.7513. And that gives me 7513. Okay. And when I add all those up, I get a total of 25,033.40. And when I compare that to the 30,000, I'm going to get a what? Negative net present value of this 4966.6. I guess they carried the decimals out a little bit more than we did, whatever. I got just 0.6. But obviously what? This is the right answer, right? Okay. Now, would you do this project? You would not do this project because it's got a negative net present value, right? Okay. Okay, good. Let's take a look at Porter Company. Has 2 projects. Only one can be selected, and they want to see which one you plan to do first, and you're using what? Payback. Am I using payback method for this? Yeah, they want me to use the payback method. Okay. And they want me to see which one I should do, right? Okay. So I go ahead and I take my $68,000 for project X, and the payback period is what? 2.83 years. Okay. And then I have to compare that to what? To project Y. And if I look at project Y, and I start looking at that 60,000 is what I'm going to have to recover, I'm going to get 4,000 in year 1, so I still would not have picked it up by year 1, right? So I take 4,000 off of that. Now I've got what, 56,000 left to go? And I take 26,000 off of that for year 2, so I still don't have it in year 2, right? And then what do I got here now? 30,000. And I take what? 26,000. So by the end of year 3, I still have not recovered my costs. I still have 4,000 to go, don't I? It's not until sometime in year 4 that I'm going to pick up that money. Meanwhile, what? Somewhere towards the end of year 3, I had recovered my money on Project X, right? So Project X is a better project because it's got a quicker payback period, right? Project X, we simply took the what? We simply took the 24,000, divided it by this 2.83. I mean, this 24,000, that was how much it was going to be. We divided it into what we're going to have to invest. We would recover it in 2.83 years, right? Whereas Project Y, as I just indicated to you, we started having to go all the way to year 4. So which one paid back quicker? Guys, your test is not going to be any easier than this. If you're having trouble with this, this would be a good time to say, I have no idea what's going on. Because you're going to have to start to get past these now, okay? Huh? 2.83? If the thing costs me $68,000 and I'm going to get out of it $24,000 a year, then that means it's going to take me 2.83 years to recover everything, right? Right? Whereas Project X, the way I had to, Y I should say, the way I had to evaluate it was I had to sit here and I had to just do it year by year, right? 60,000 minus 4,000. Year 1, nope. I've only covered 4,000, still got 56,000 to go, right? Year 2, I'll get 26,000. Nope. Still got 30,000 to go before I recover my costs, right? Year 3, I subtract 26,000. Nope. Still got 4,000 to go. Meanwhile, towards the end of year 2, Project, I keep forgetting which is which, Project X had already recovered its money, right? Okay. Okay, good. Now this one, they give me the present value factors for each year, but then they also give me the present value of an annuity. And they were being generous to me by giving that to me because what? Here's the annuity for Project 8. It's an even amount of cash flows, isn't it? Right? So if I want to know the present value of Project A, I do what? I take 2.2832 and I multiply that times 8,000, and when I do, that gives me 17,000, $826.56. Okay, and then what? Then I go ahead and I start to look at the present value for B. And B, they were kind of generous to me in that what? There were no cash flows in the first 2 years, so I don't have to deal with these, right? It's just a year 3 one-time cash flow that's going to come in on this, so I can pick up that factor, right? And so I pick up that 24,000 and I multiply that times 0.6575. That 24,000 times 0.6575 gives me 15,780, right? So they wanted to know what? Both investments, and how much are they going to have to spend up front? They have to spend what? 15,000 up front. So remember, we'd have to have what? Our net present value either be 15,000 or more. So both of them are what? are more, so both are acceptable projects, but if I had to rank them, whatever it is that project A? Project A is better than project B, isn't it? So project A would be number 1, project B would be number 2, right? Oh, what do they tell us? They only can choose one? I guess they can set here they can only choose one. They say which investment should they choose, and assuming they can only choose one, they should choose A. They didn't really say that and make that very clear, but that's what they wanted you to think. Okay. A is better because it has a higher net present value, right? Okay, good. Then you came over to number 30 here, and we've got this Carter Company, and Carter Company is trying to figure out its residual income here. And so what are we going to do? We're going to pick up our sales minus our cost of goods sold minus our operating expenses. That gives us our operating income on this, doesn't it? And then we set up sort of that hurdle, which is going to be our return on our assets, which is our total assets of 4,100 times the what? 10% basically target income that they're looking for. And so our what? 6,300, 603,000 minus 10% of 4,100 gives us the 193,000. Okay. Okay, this one, another residual income. Pretty easy questions, right? Our sales minus what? Minus our cost of goods sold minus our operating expenses gives us operating income. Operating income minus the targeted return on our assets gives us a what? Residual income of this 133. Okay, good. Number 32. I think we had done another one of these before where we did a different division. Okay, but we had done something similar. This one asked for Department 1's contribution overhead as a percent of sales. I think we've done another name of a company. So we've done a few of these now. But we have what? We've got the $1 million. We picked that up. What are we looking for? Department 1? We've got what? Cost of goods sold of 700,000. Should I pick up the direct expenses? Direct expenses here are what? 100,000? How about the indirect? Nope. Stop there. And when I get that, I get choice C is what? Oh, I didn't give you the choices? So that's 200,000. Okay, so make sure you're comfortable with if I give you what? If I give you Department 1 in a question, you should be working Department 2 and 3 for practice, right? And there's always a chance that the actual exam is going to have the other departments. Okay, good. Let's take a look at number 3, Carter Company. And we got what? Return on investment we want here now? So we're going to pick up what? Sales minus cost of goods sold here. Minus, should we pick up the operating income? Operating expenses. That all gives me an operating income. We've already worked this same question, right? Essentially, now they just wanted the return on the investment by itself without throwing in a residual income consideration here. So it's 603,000 divided by what? The assets here of just this calculation right here, 4,100,000 gives me return on investment of, we already saw this, 14.7%. So it's the same question we worked before, where you get the return on investment and then you apply it to the assets, and that gives you the hurdle that they're trying to get over, and you just subtract the operating income from that, and that gives you the residual income. Okay, these guys again, fabrication, purchasing, maintenance. This time we want what? Maintenance department going to be allocated to who? Fabrication, and I'm thinking maintenance is floor space. We add these two together. What's that? 6,000? Okay, and we're looking for who? Fabrication here. So we're going to take that 18,000 of maintenance, and we're going to multiply it by fabrication share of the floor space, right? Which is, yeah, whatever, square footage of space. 3,300 divided by the 6,000. And what's that give us? Yeah, I think 9,900, you say? Yeah, I think this one, somebody pointed out to me during the test itself that, I don't know why, I think it gave you the other one. It asked for maintenance, it asked for fabrication, but it gave you assemblies number. I think that number was assemblies number, okay, as the answer. The answer here is not 8,100, it's what? 9,900, not and I'm pretty sure that one that it gave you, for whatever reason, the test bank flipped it. They gave you what? Yeah. See, they gave you what? 2,700 would have been, what's the other department? Assemblies. So they gave you assembly here. Okay. Question on that? Or it could be when I copied it, I copied the wrong answer that went along with the question. Who knows? But anyway, it's either them or me. Okay. 35, Department 1. Did we give you the departments? Is this another one of those stupid ones where I didn't give you the information? Okay. So what do we got? We have 15,000. We know we're going to have to allocate that one, so I guess I'll discover on my own if everything's here. And we have what? They have a small building, 10,000 square feet of space. Cost is allocated by 3 departments on the basis of the amount of floor space. And they give me the 3 departments, Department 1. And since they're asking me Department 1, I'm going to go ahead and multiply that by what? 2,000 divided by, and they told me the total here, so I don't have to add that up. It's 10,000. By the way, guys, I would go ahead in questions and re-add the totals when you're on the test, just to make sure. I don't trust them, you know. There's nothing we can do to them if they screwed it up. So 15,000 times what? Times 20% means that 3,000 is going to go to Department 1. Okay, good. Number 36. This one got some weird spacing in it. But we've got these 2 departments here. We got administrative and maintenance. And then administration is based on workers in each department. Maintenance is square footage. Okay, and they're looking for the amount that should be allocated to who? The assembly department. And whose costs are we trying to pick up? Maintenance. So we know we got to pick up that 100,000. And we're allocating it to who? Assembly. Okay. And so they tell me here that assembly occupies what, 44,000 square feet versus the 30,000 square feet for painting. So that's what, a total of 100,000 square feet? Am I doing my math right? That I'm doing in my head here? Okay, guys, so after this question, I'm just going to go ahead and cut it off. Okay, since you obviously have tuned out at this point, there's no reason, I don't need to practice these. Okay, so we'll just tune it out. We'll just cut it off after this. But it's $100,000. That's what? It's 80,000 total? Okay. So we got 80,000. Okay, so what? That gives me a percentage, 100,000 times what? $100,000 times. Oh, what do I have to get everything, huh? So that's 55,000. So it's times 55%. Okay, so they wanted the total, right? So it's not just one, they want the total of everything, right? Okay, the total amount of indirect, which is going to be both administration and maintenance. So we've done maintenance. How about administration? That's going to be 80,000. That's based on the number of employees. And there's what, 150 employees in one and 100 in the other. So that's a total of 150, 250. And how many of them are in assembly? 150. Okay, so we've got 150 in assembly. So if we take the fraction here, we get what? 48,000. Okay, so you take the 55,000 plus the 48,000. That gives me what? 103,000. C is the answer. Okay. Okay, and again, when you look at these questions, since this one was asking assembly, a good practice for the test would be to do what? Do the painting department as your practice for your exam, as part of your practice for the exam. I'm thinking we've got easily in the neighborhood of what, a couple hundred questions you can be working through, okay, as you get ready for this test. And I would make as a project, all 200. Okay, and if you do that, you work through all 200, you got as if you start right now, you got a week. And you sat there and you worked through all 200 of those questions. I can't see why you would walk in here and not just crush this exam. And remember that we've got what? We've only got 2 hours, so you do need to be pretty proficient at these, right? Unless there's no class in here afterwards. If they don't kick us out, we can stay longer, but I don't know that that's the case. So, okay, let's take a look at this one. The following information relates to next year's projected operating results of the consumer division. If the consumer division is eliminated, 1,600,000 of the above fixed cost could be avoided. What will be the effect on, what is that, Zampa's profit next year if the consumer division is eliminated? Well, we're sitting here and we have what? We have 180,000 as the contribution margin. And they're telling us that what? If we got rid of that division, we could avoid this 160,000 of fixed cost, but we would still have a what? Segment margin left of 200,000. So if we get rid of Zampa, we're going to do what? We're going to get rid of that contribution margin that's contributing to the fixed costs that aren't going away. They're going to be there regardless, right? Okay, so we would have an overall what? Decrease in the profitability of the company for this, right? Question? Right? Okay, even after you get rid of the avoidable fixed costs, they're still contributing 200,000. Okay. Okay, good. So we've got these two divisions, cork and rubber, and they're asking me, well, what happens if I get rid of, I think in this one, they wanted to know what happens if I get rid of the rubber division, right? What would have happened if I got rid of the rubber division? And with this one, guys, you go straight to what? You go straight to the segment margin. Okay, traceable fixed costs are identical to avoidable. If I can trace it to the division, then that cost is what? That cost is avoidable, isn't it? If I can trace it. If it's what? If it's allocated and it's a common cost, getting rid of that division does nothing to help me avoid that cost, right? And so this is really the same question as we asked before. Then the overall impact is if you get rid of a segment and it had a contribution margin before any avoidable fixed cost, then you're going to lower the overall income of the company by getting rid of that division's contribution margin, right? You'd only get rid of the, obviously, the variable. Well, you get rid of the sales, of course. You get rid of the variable cost. You get rid of the traceable, the unavoidable, the avoidable fixed cost, but you don't get rid of the unavoidable fixed cost, right? Okay. If there's a question, I'd address it now because we're running out of time. Okay. Let's take a look at this Bailey Corporation. And they want to know whether or not they should discontinue this product G. And they say all expenses other than fixed manufacturing costs are avoidable if the product is dropped. None of the fixed manufacturing cost is avoidable. Okay? And so what happens? Well, I'm sitting here and I'm looking at it and they say it'll decrease 15,000. And the way I looked at this is I said, well, look, I have a what? I have a contribution here of how much? I have sales of actually, the way I looked at it was this. I took a little bit of a different approach. They said none of the fixed manufacturing overhead could be avoided. Where they say trying to decide whether, and they say all expenses other than the fixed manufacturing head are avoidable, I should say. The fixed manufacturing overhead are avoidable. So I'm looking at that and I'm saying, okay, well, look, right now I have a $55,000 loss here, don't I? Right? And what would happen? I would sit there and I would go ahead and no longer have this 70,000. I mean, I would still have this 70,000 to which there wouldn't be any contribution to. So I would have what? A $15,000 decrease, right? Is the way I looked at that. if I'm sitting here and I have the 70,000 costs that aren't going away, then I no longer have a contribution towards those 70, so I'm going to sit there and have a decrease of 15. Let's see if we can do it the longer way, though. So we have what? Sales of 750. I have what? Variable production cost of 450. I have sales commissions of what? 110. I have salary of product manager of 95. And then I've got what? Fixed product advertising of 80. So what happens when I subtract all those? I get the 15,000, right? Okay, so they're still contributing what? Towards my fixed cost of 70,000. That's how I ended up with what? After you subtract the 70,000, that's why my loss was only 55,000. So I'm saying if you did nothing, the way I did it the shorter way, if you did nothing, you'd still have what? A $70,000 loss. If nothing else happened, you'd be stuck with that fixed cost, right? And so what's happening, if they're only showing a $55,000 loss when I have product G, then that means if I got rid of product G, I'd have what? I'd have a loss of 15,000, a loss of 15,000 more. I'd have the 70,000 loss because I would have got rid of everything else that happened, right? Okay, so I'm just showing you a quicker way to work these if you really understand what's going on with these. You'll always get the answer doing this, and I think you'll have the time to do that. But if you got in a crunch, you might start thinking about looking at questions like that in that manner. Okay, okay, they did it right here. Hello. They did it right here using the longer approach. Okay, good. Let's take a look at number 40. A company has the choice of either selling 600 defective units as scrap or rebuilding them. And when they sit there and they rebuild them, they can sell them for $2 per unit. Alternatively, it could rebuild them with incremental cost of, the company could sell the defective units as they are at what? $2 per unit. Alternatively, it could rebuild them with incremental costs of 60 cents per unit for materials, $1 for labor, 80 cents for overhead, and then sell the rebuilt units at $5 each. What should the company do? And so we go ahead and we say, okay, and you can work these a number of ways, but I like this. This works for me. $5 is going to be the price of the rebuilt units, but they're going to go ahead and instead do what? Consider the alternative of selling them for $2 a unit. So if we go ahead and rework them, we'll make what? $3 per unit. Okay. Then we have to consider the cost of rebuilding, 60 cents for materials, $1 for labor, 80 cents for overhead, which came right out of the problem. That means that what? There will be an increase of incremental cost of 40 cents. So we'll get what? 60 cents per unit for rebuilding these. So we should do this. Okay. Okay, good. 41 now is this, I think we had this problem. And that's not to say that we hadn't had some of these others, but for some reason I recognize this one. This Angram Corp had 1,000 defective units, a product that cost $3 per unit in direct costs and $6.50 per unit in indirect costs when produced last year. The units can be sold for $4 per unit or reworked at additional costs of $2.50 and sold for $12. Okay, And so the incremental net income loss from the choice of reworking the units, we just had this one, didn't we? Is 10,500. I think we had the same exact problem on this test, right? Well, at least we're consistent. So it was what? It was, Omar, the 12,000 minus the direct cost of the rework is 9,500. Okay. Okay, good. Number 42, Miner Electric has received a special order, and they want to know if we should accept this special order. It's 1,500 light fixtures, and it's going to be $5 per unit. Miner currently produces and sells 7,500 units at $6 each. This level represents 75% of capacity. Now, of course, they're telling us this because if we know that if we have excess capacity, we can go ahead and do the more profitable items here, right? Okay, so if it was 100%, we'd have to obviously have these be more per unit than what we're currently selling them for. But if we're under capacity, then we could very well accept a lower price per product. Production costs for these units are $4.50 per unit. It includes $3 variable costs and $1.50 fixed cost. To produce the special order, a new machine needs to be purchased at a cost of $1,000 with a zero salvage value. Management expects no other changes in costs as a result of this additional production should the company accept the special order. And so we go ahead and we have our revenue per unit is $5, and it's what, 1,500 units? Just to make it clear, 5 times what? The 1,500 units is where they got that 7,500. And then they're telling us that the additional cost is $3 per unit. That's obviously what? The $3 times the 1,500 units is where they got that. Okay. The new machine, and I think I might have objected to this question before, or one like it when we look, because I said, well, shouldn't we consider the present value of what that machine is going to generate? But now reading the question more carefully here, reading the same question the second time, whatever, they tell us it's a one-time deal, right? So since it's one time, the presumption is I can't use this new machine for anything else, right? So it is relevant to consider it just for this 1 year. And so my total cost for this project versus what? Versus my total income for this project, not necessarily in that order as I stated them and circled them, is going to be $2,000. So they should accept it. Okay. Okay, good. Walters Company. Oh, important takeaway there was what, guys? What did we not use? We didn't consider the fixed costs, right? Per unit, the presumption is that those aren't going to go away. Okay. Okay, good. We come over and we look at this one. Walters Company manufactures a special food product that can currently be sold for $22 per unit. Okay, and we have 20,000 units on hand. Alternatively, we could further process it at a cost of 12,000 and convert it into 12,000 units of deluxe and 6,000 units of super. The selling price of the deluxe and the super are $30 and $20 respectively. The incremental net income. Okay, so what are we going to do? Well, right now, if we produce these further, we can get what? $30 of unit per the deluxe and 6,000 of units per the super per the prices they give us. So that would be what? 488,000. If we sold the things now, we'd get what? We'd get $22 a unit at 20,000 units. That's 440. And then we'll have an incremental revenue of 40,000. And then the cost to process further, they told us was 12,000. So they should totally go for it, right? Right? Okay. And I think the trick to a lot of these guys is repetition. Okay, so again, the more you do these, the more you get sort of, you're in your head, oh, okay, this is the sort of the pattern of these, right? And you're going to be, feeling pretty good about these on the exam. A company whose sales will not affect Cornish Materials offer to buy 3,000 units at $17 per unit. In addition to variable manufacturing, selling these units would increase fixed costs by 500 and selling and administrative costs by 1,000. If Cornish accepts the offer, what will happen? Let's just look. Selling $17 per unit. Direct materials, and the only thing that was weird here is you had to turn these into per unit cost. So it's what, 200,000 divided by the 20,000 units, and then where's the 200,000 coming from? Oh, it's up here in the table, right? Thank you. Direct materials divided by what? Divided by the 20,000 units gave me the, what was it, $2 per unit? I mean, $10 per unit. So that's $10 per unit. Then we went ahead and that was for materials and labor. And then the overhead, and this got a little bit tricky because they tell me what part is variable. 40% of it. So I had to take the 100,000 times what? Times 0.4, and that gave me 40,000. And then I divide that by what? The 20,000 units, and that gives me $2, doesn't it? Per unit. Okay, so that was a little bit tricky. So we got the 10. We got the 2. That's it, right? Everything else is fixed. Okay, so that gives me contribution margin times the additional units. And that gives me the 15,000. Oh, I see what they did. And then they went ahead and did what? Took out, because they did tell us there was additional overhead and additional selling and administrative. Problem told me. Additional selling and administrative. And additional fixed costs. So I had to pick those up. Okay. Which one? You want me to switch out the size on it so you can see the whole thing? Well, let's see if I have to go through hellfire to do it. The answer will be no. But if I can get it to cooperate, the answer would be yes. Is there a question on that one, Omar? Well, there's the selling price, right? And then we know we have to pick up the variable cost, right? And the thing that made the variable cost tricky is if you looked up in the table here, they told us that they were at the current situation, where is it? 200,000 for 20,000 units. So 200,000, which why it's disappeared now, I have no idea, because I know, unless I was dreaming, I know I wrote it there. Now it's back, but for some reason I can't. Let's see if maybe when I save it, it'll let me come back. This is why I need the i7 processor in the tablet. Okay. Already clicked on that. Okay. What number? 44. Okay, so we've got the sales price, right? And then we picked up what? Our total of our materials and our labor. And up in that table that I don't want to get back up there because it'll crash the computer if I try to, is what? 20,000. So that's $10 per item. And then they told us we had the overhead of 100, but it said 40% is variable. So we'd get rid of that 40%, right? So we take the 100,000 times divided by 20,000. That's what, $2 per. And then, I mean, not 200,000, but 40. Did I say 40,000? 40,000. 100,000 times 0.4 is 40,000. Divide that by 20, that's the 2. And then that gave us our total variable. That gave us the contribution margin times the number of units. And then the last couple of steps there were to subtract out the fixed cost associated with this project, right? And once we did that, that told us that we had an incremental income of 13,500. Okay, guys, any particular one that you want to request? Because, I mean, this starts to become more of the same, and we're starting to run out of time now. I'll tell you what, let's do this. Probably makes more sense. If you have one that you want to look at, we'll put that at the beginning of next time. Okay. Omar? Yeah. So you're going to be here, right? So at the beginning of the next class, we'll either do, in fact, we'll just go through the rest of these at the beginning of next time, and then I'll have like 4 or 5 more questions, maybe 6 more questions, 3 on absorption, 3 on the budgeting, just to make sure we stay in communication on that. And then the balance of the class period will be request line, or if you want to leave after that. So I would suggest everybody come next time just to see the rest of this. And then but it won't be a full class if you want to leave after that. Or if you just feel, hey, I'm in good shape, then you know, your decision on that, all right? The test is when? Monday, 12/12, 9:30 to 11:30. Same procedure as last time. Bring the Scantron. And hang on, guys, because we're going to do the evaluations. Bring the Scantron, and that's it. Skinny green on the Scantron. 50 questions on one side, 50 on the other. You'll have 50 questions on this test. All right? Okay, guys, hang tight, Jarn. I'm going to turn it over to you. I think it's okay if we start this while I'm breaking down things, and then I'll exit as you complete those. Okay, guys, we'll see you on Wednesday or on the final exam.